Hi guys, welcome back. Today we're going to be looking at 3M and whether it's a good dividend investment. It's increased its dividend continuously for the last 63 years, making it a dividend aristocrat, and over the last few years has gone through some company restructuring to have some growth potential in the future. So today we're going to be looking at whether this company is a buy. If you do enjoy, consider subscribing. It is free and it does help me out a ton. If not, thanks for watching anyway. Onto the video. So before we begin, just a bit about 3M. It's an industrial conglomerate that sells thousands of products in hundreds of industries all across the world. It operates in fields such as healthcare, consumer goods, industrial and home appliances, worker safety, and even more. It sells over 60,000 items under countless number of brands and operates in more than 70 countries all across the world. In 2018, it was ranked 95 out of 500 in the Fortune 500 as the largest companies in terms of revenue. And it's also a dividend aristocrat with a 3% dividend yield and has been increasing its dividend consecutively for 63 years. The company strength lies and the economic moats that it has lies in the number of patents that it holds. It holds more than 100,000 patents by 2014 and is acquiring since then about 3,000 patents per year. An example of a very important patent that it owns was the N95 surgical masks that are used all across the world last year to prevent COVID and are still being used nowadays. So last year, with even one of the worst recessions in the world over the last 75 years, their revenue only fell down by 7%. Their profit hit new highs and their sales were up 0.1%. This shows the resilience and how having such a wide range of things to sell when some of the goods that they sold dropped, such as home appliances and consumer goods. On the other hand, their healthcare sector, or their N95 masks more specifically, kind of balanced that out, making it actually a profitable year for them, and it shows how resilient this company is in the short term, but also in the long term if you're looking for a safe bet to buy. The next thing we're going to be looking at is future growth. So recently the company started to prioritize investments where the demand is strong and sustainable. So this was specifically highlighted in their recent earnings call was personal safety, healthcare, EVs, semiconductor, data centers, and home improvement. They also plan to increase operational efficiency to improve their profit margins. And part of this also includes selling off or decommissioning redundant sectors as a part of, in their company. This also includes a mid to long-term shift towards e-commerce to start selling their goods online in their own platform, but also to focus on redistributing goods in emerging markets such as China. They're more specifically focusing on data centers, semiconductors, and EVs, as these has huge growth marketplace in the near term and in the long term as the demand for these continues to grow. And they're also looking to gain traction in China, especially with the EVs and semiconductors. However, currently this will be put on hold due to the trade war going on between the US and China. The revenue and earnings are set to grow healthily over the next 5 years, and we're looking at a 10% year-on-year growth for the next few years, which is quite healthy, but nothing market-beating to expect. The next thing we're going to be looking at is the valuations and financials of this company. They have a price to forward earnings of 20, and while this isn't the cheapest you could look at it, it's trading at quite a valuation compared to their competitors and the market as a whole, which is touching maybe the 30-40 PE price to forward earnings, especially the fastest growing companies in the world right now. It has a PEG ratio of 2.15, which shows that in terms of growth it is slightly overvalued, but the dividend does bring that down slightly, making it a decent buy purely on the valuations. The earnings per share consistently increasing over the last 10 years, which is very good. Their dividends and their payout ratio both increasing. That's also very good. The book value per share has remained pretty solid, so that's not really anything to look forward to. Their operating cash flow, cap spending, and free cash flow have all increased, which means more money is coming into the company, more money staying in the company, and more money is going out as well. And they're also holding more money in terms of cash when we're looking at their free cash flow increasing as well. Their net margin is pretty healthy, especially for a capital-intensive business that it runs, at 16.73%, so that's good. And their return on equity is exceptional. We're looking at 47% return on equity, which is amazing for a company of this size. The interest coverage is pretty healthy at 14 years, but their debt is quite high at 1.45 debt to equity. So this company does have quite high debt but they are able to pay off their interest for quite a while should they run into any troubles in the future. The last thing we're going to be looking at today is the technical analysis. We can see over the last year, the company has made quite a good comeback from about $136 all the way to $200 right now. We can see every time the company rebounds, it hits the red line before coming back to the green, and recently it's hit a new high. So based on recent trends, I would expect it to fall back down, looking at maybe a 5 to 10% drop. And if that does occur, I would recommend a buy price about $185, which is slightly more conservative in between the two lines. So just some final words. It is a large conglomerate company with strong economic moats. Over the last 10 years or so, it had dwindling future growth, but recently there's been a company restructuring, and the potential is there if it's executed properly. It's currently trading at cheap valuations, but the stock price is slightly expensive, looking at the graph we just saw on the last slide, but has been a very strong dividend aristocrat and is a very safe bet for the long-term investors. However, just to keep in mind, the risk is there if A, they don't keep their growth potential, or the management is not able to execute their growth potential properly, and on the fact that they have recently been losing market share over the last 10 years or so. But if you do choose to invest, make sure to do your own due diligence, and thanks for watching. Bye.